500, obviously. And if we take a look at the S&P 500, we have what I call Landry Light. And Landry Light is simply the highs or less than the moving average. In this case, I'm using a 30-day exponential moving average, and that is illustrated down below. And this just counts the number of days, not the magnitude of the move, but the number of days. So you can see prices actually coming back to the moving average, but this is going to continue this negative count until and unless we intersect that moving average. A lot of times you'll get like a kiss of that moving average. Like this was almost a kiss right here, and I call it a Landry Light pullback. And that's a good setup to trade in general stocks in general. But it's also a good signal to watch in the overall market. Bow ties is another thing that I paid careful attention to. And bow ties are simply a 10-day exponential, a 20-day exponential, and a 30-day exponential moving average. And when they come together, it can look like a bow tie. And this is, again, illustrated down below. And the reason that it is, I use the word illustrated because I don't believe that indicators indicate anything. If you had an indicator that actually indicated where a market was headed, you'd own the world. But they do help to illustrate what's actually in the charts. And when it goes from, again, green, meaning that 10 is greater than 20 and 20 is greater than 30, and again, 10 simple, 20 exponential, 30 exponential. When that happens over a short period of time, it gives the appearance of a bow tie, and it suggests that the major trends are turning. Now, that's on a daily chart. We'll take a look at a weekly in 1 second. But no matter what you're doing with indicators, and I would say 95% of my work is done without indicators whatsoever. You're probably like, well, but Dave, every time you're in a webinar, you show them indicators. Well, that's so I could that helps me again to illustrate what's happening in the market. And after you do your analysis with a blank chart, and I often talk about drawing the big blue arrow, which is just a big blue arrow in the direction of the trend. That would be pointing down at the moment. But after you do that, then you could do some of these other things that might help wake you up to what's actually happening. Okay. So you can see we were green here, but notice that the market wasn't making any forward progress for quite some time. So again, always look at the chart. But the bow tie, if you're trading it as a setup in and of itself, you're looking for a 1 bar pullback. So this would be technically a 1 bar pullback, but that's just a higher low. So the first higher low and higher high would be on this bar here. So the trigger would be there. Let's take a look at a weekly real quick. And we could circle back to all of this stuff. I know I'm going kind of quick, but I'll be happy to do that at any point in time. So this is getting ready to change to red now because these moving averages have crossed over to the downside. Now, when you have these weekly signals, that could be kind of a major thing. And this is, again, proper order, 10 greater than 20 greater than 30. Notice this nice bull trend we had in here. Notice back here, the market was kind of weak to choppy, and we were going back and forth from green to red, in this case, green to yellow, meaning that it's neither an uptrend proper order or downtrend proper order. But if you back this way, way, way out, you can go and see all the financial debacles over the year. Here's 2000, obviously, and we had a nice trend lower in that. Notice that we're mostly red on the bow ties. Nice little bull trend in between, mostly green, and then again red. Now, one more time, make sure you're looking at the charts when you're doing all this, but it does help to keep you on the right side of the market. So that's bow ties, that's Landry Light. Let me show you one more thing with the S&P 500. I have a simple system I call the TFM 10% system. And the premise here is that if a market is going to drop 50%, it's going to drop 10% first. So 10% is a good place to start looking to get out. Now, I have a whipsaw filter, which is the 50 simple moving average on a weekly chart. So the top of this zone would be 100% of the 50-week closing high. The bottom of the zone is 5%, and that's based on one of my clients who thinks that 5% is a good number to start thinking about getting out of the market. And he's right, but sometimes early because you'll have a few dips into that zone, obviously, and the market will continue higher. But anyway, the whole system in and of itself on the sell side is just a close below the moving average and a close 10% or more away from the 50-week closing high. So right here, this was a sell signal. Now, in this sell signal, this is something I didn't discover until real-time trading. And that's the thing about when you pay attention to something mechanically. In the future, sometimes it doesn't shake out exactly like it did in the past. In this case, this is a calendar chart, and I thought it was a rolling weekly chart. So this was obviously more than a 10% spill, and that's what I like to keep it to when you're exiting on these longer term positions. Now, as far as stocks that I'm long, there's only one stock that I'm long right now, and that's AGI, and I'm short a few stocks. AGI is a gold stock, and that's about the only thing now that's trending uh, for at the moment at least. And we're getting fairly close to our initial profit target on this. And this was just a move I call a trend knockout. Let me get back to a regular chart on this one. Let's see if we could find the moving averages. Now, if anybody has questions, just let me know as I go. I'm just going to talk for a few more minutes, and then we obviously can open it up to questions. But yeah, this was a pattern I call a trend knockout, and that's when you have a sell off fairly hard after making brand new highs. It's a form of pullback. And notice that we also took out that 30 EMA. Now, as a general statement, I would recommend you not trade any market or not buy any market if it's trading below the 30 EMA. Nothing wrong with having a market dip down to it like this one did here, okay? And that the Landry light goes from, it was about 60 right here. You can see lots and lots of bars above that moving average. Again, 30 EMA. And then we dip down to it. So we got long right around here. And our IPT, I think, if memory serves, is right around 31 on that one. Now, we are short a few stocks at the moment. We're short Carnival Cruise Lines, and that was off of a bow tie setup. So let me just punch that in real quick. So again, here's a stock in a longer term uptrend. It's at all-time highs. Everybody's happy at all-time highs. Now, keep in mind, everything I do when it comes to technical analysis is reading the psychology of the market. There's no mumbo jumbo involved or fancy indicators or anything like that. Again, the indicators I use just help to illustrate what's happening. But at all-time highs, everyone's happy. When the market begins to crack a little bit, then those who bought at the high are beginning to feel a little pain. And then you have things like overhead supply. So anybody who bought in this range, once you drop below the range, they might look to get out at break even. So that becomes a bit of a ceiling for the market, or can. Certainly an area of resistance. But anyway, the bow tie, as you can see, the moving averages came together, formed the bow tie, and the entry was right around here, I believe, if memory serves. And we took the initial profit target out, and we're trailing the stop lower on that one. So far, so good, knock on wood. Now let's take a look at TPR. TPR is another one that we're short. And again, that's that bow tie pattern once more, and you can see it pull back a little bit. And initially, we took a little heat on the position. I think we got in right here. It shot higher, but then it went down, hit the initial profit target. And this still looks like a stock that's in lots and lots of trouble. We have one more that we're short. Let me take a look at this real quick. It's JBL. Now, JBL has been going against us a little bit lately, but you can see that this was another one that actually we stopped out of this one. This was one that we were short, and we stopped out of it recently on this big retrace rally back up. But it still looks like it's in trouble. And I think that's it as far as the positions for now. Seems like there's a third one. Let's see if I can get that up real quick. I can't get that up on the fly. So any questions so far, or anything else you guys want me to start looking at or talking about? Let me show you something real quick while we're doing this. Now, another thing that happened recently, and let me see if I get my share back to a new share. So this is an article I'm working on now. Let's see if it'll get to it. Okay, here we go. And Jim Kinney, who occasionally hosts, he's a current host of the Crowd Forecast News, right, David? He often asks a question. Yeah, okay. So he often asks a great question, and that question is what keeps you up at night? And this is a piece I'm working on called Random Thoughts. And he asked this question, which I think is a great question. And the gist of this article, as I talked about in the last show I was in, is that I had a friend of mine about 12 years ago, friend/colleague, and he was really concerned with the amount of spreading that was going on in the markets, incredible leverage spreading. And he was worried about it turning into like a a long-term capital management times 10. So this was long-term capital management debacle. I don't know if a lot of people here are probably not old enough to remember that, but it was a crazy time in the markets when that hedge fund blew up. Of course, the government bailed them out. They never bail me out in my trading when I do stupid stuff, but that's another story altogether. But anyway, so he was really concerned about a long-term capital management situation, and that was 12 years ago. And a lot has happened between now and then. And my wife asked me, "Is this guy right?" I said, "Well, he's right, but early. He shut down his fund. He was moving across the country, and he stopped at our house along the way. And we obviously talked about these things further. But we are getting a lot of signals, like I just said. And we had the daily bow tie we just talked about. We had the Landry light pullback in the S&P 500, and of course the big blue arrow, and that's just simply looking at the net price change and drawing an arrow on the chart. Now, one other thing that's happened recently is we got a death cross in the S&P 500. The Nasdaq made a death cross a few weeks ago. Now, the thing here is it's not the signal in and of itself. Somebody a while back I was talking with, and he tested it, and I think it was Rob Hanna tested it, and it's a very slight edge. If you sell when the market drops below, when the 50 simple moving average crosses the 208 simple moving average, if you sell then and then you buy when it crosses back above, there's a very slight edge, not worth trading, believe me. But what I did was, and I think I'm trying to think of the guy's name at the moment. I have an article I could pull up in a second. But what I did was I went in and looked at the magnitude of the move below. So a lot of times you have these death cross situations, and then the market might drop 30 or 40% from that and then come back eventually. So the mechanical signal is not as relevant as what could happen below it. Now, you could really make that argument for anything. You can make that for my bow ties. You can make that for the Landry light, like we just talked about, or any other trend following indicator or illustrator, however you want to look at it. A lot of trend following will look alike. I think my stuff is pretty good, and a lot of people like my stuff, but I'm sure others have something that's similar. You're basically trying to figure out what direction price is moving, and sometimes the best thing again is a big blue arrow, and then you're trying to figure out a place to get on the price, get on that, and capitalize on a price movement. Obviously, the only way to ever make money trading is to capture a trend. So lots and lots of sell signals in the market, one day at a time. Obviously, we're in a big retrace rally. I think we could retrace a lot further, and the market would still be in trouble, maybe all the way back to the 200-day moving average. I wouldn't get too excited until and unless we could start banging out some serious new highs in the market. Okay, questions? All right, let me just keep jumping ahead. David, do I need to look at the chat, or is that something that you're going to field?
Um, yeah, can you see the chat?
Yeah, let me see if I can do that. Let's see. I see it says chat. Oh, here we go. Okay. Oh, good. Fantastic. Okay. So somebody said AU is moving recently. Yeah, that would be gold, obviously. So that's one of the few areas that is currently working. So let me get this shared over. I lost my oh, here we go. So I'll hop over here. So if you take a look at gold to commodity is just off of brand new highs. This is GLD, and that's a good representative of what's happening in the underlying gold stocks. Gold stocks are actually doing a little bit better than gold, and technically they should if gold is moving higher because the gold stocks are quite leveraged by with when it comes to the gold. The gold price goes up an ounce, their stock's worth a lot more than it was before. But anyway, so we're long. What was it? AGI there. Again, AGI. A little bit of an opening gap reversal today, but so far, at least it's trading at brand new highs. So that's certainly a good thing. Now, the thing that's kind of scary is no place to run, no place to hide. There's the energies you can see looking pretty ugly. All service is looking extremely ugly. You can see that's absolutely imploded as of late. Mags, the prior darlings. In fact, I'm just noticing this today. Looks like we've got a death cross as of today. Bow tie proper order to the downside for a long, long time, all the way since way up here. So that's when trend following really works when a trend materializes from what you're seeing. But if you go through tons of these ETFs like robotics, they pretty much all look the same. And what's scary is one of the stronger areas was insurance, but you could see that it's imploded and now it's in this retrace rally. And we have a short that we're looking to take today in insurance. So other than gold, I'm not really seeing anything. Now, the rest of the world, the old stock market adage, United States sneezes and the world gets a cold, uh, was not did not ring true for a while, but it eventually caught up to the EFA shares. Now they've had a tremendous retrace, but I still think they're in trouble at least for now. I certainly wouldn't rush out and buy them at this level. So again, no place to run, no place to hide when it comes to the markets. And some of the stronger areas I think might be your best opportunities. Now you don't want to short an area, make a new highs, but something like insurance that's had a big retrace rally and could be on the cusp of rolling back over like it is a little bit so far today, that might be worth shorting. I would prefer doing that as opposed to, and I don't have a great example off the top of my mind, but some of these stocks that are in longer term out downtrends, like probably some of these old service stocks. This is OIH. I think you'd be better off trying to find something just beginning to roll over from high levels like insurance as opposed to something in a longer term downtrend. You sort of want to match the pattern to the market. So if you take a look at the market, we're still kind of in the early phases of something that could be much, much bigger. So that's where you want to be looking for opportunities, those stocks that are still at fairly high levels. And again, don't fight the trend, but on the way moving down. Okay, FTDR. FTDR. Okay, so here's one that's really imploded already, and it's at fairly low levels. Okay, so yeah, this is an ugly looking stock if you wanted to short it, but you're all the way back down to this wide and loose trading right here, and then you just had a couple of days of implosion, and then it just kind of began to just kind of chop around in here. So I would not take that one as a possible long or short. Easy PW. Now, this is actually one of the few good-looking stocks out there. It's in an uptrend. It's a little wide and loose and a little choppy, but I can't argue with you on that. It's definitely an uptrend. The only, however, is except for like gold stocks right now, you really don't want to rush out and play the relative strength game. So, what do I mean by that? Well, there's an old adage, there's always a bull market somewhere. Well, that's not necessarily true. Sometimes all stocks are headed lower, especially if we get into an extended bear market. So it's very dangerous to buy a stock in general that's not commodity related or doesn't have a concrete reason why it could possibly trade contra to the overall market. So even if you found some longs that you sort of liked, unless they were a gold stock, at least right now, I think I would pass on those. But yeah, that's definitely trending higher. I just can't find. I just couldn't rush out and buy it. NGD, that's going to be a gold stock, so that's probably going to be a little bit better. Nope, that one's a little wide and loose. Okay, so this one was working its way higher, it imploded, and that's working its way higher again. It's kind of looks like electrocardiogram, sort of all over the place. So if you take a look at like the AGI that we're long now, you could see now gold stocks don't always trade cleanly, so you have to give them a little bit of a pass. But as a general statement, notice that you could draw a line through most of these bars in here. And notice that the trend for the most part was accelerating higher before we had this nice little knockout move. Okay. So you want to look for something cleaner within the golds. And if you have any other ones, I'll be happy to punch them out up. But you want to, as opposed to that NGD, which is kind of all over the place. So try to find something that's trading a little bit more cleanly. The question is AU the stock. Okay, let's do that. That's going to be a gold stock. Yeah. Now see, there you go. There's a stock that's a lot more cleaner. You're busting out to all-time highs here. So that on a pullback might be worth a shot. So yeah, good eye on that one. Do I use Elliott Wave? No, no. The problem with Elliott Wave is when the wave counts are in sync with the trend, it can be pretty amazing. Okay. And I saw someone give a presentation years ago, and they had a trend indicator on the bottom of the chart, and they didn't take wave counts against the trend. They only took trades with the trend, and which begs the question, why not just follow the trend with your little trend indicator, or even better, just look at the charts. Now, when Elliott Wave works, it prints money, okay, because it's in sync with the trend. So I think it was in 2007, I want to say. I had a client who was following my stuff, and at the time we had a lot of shorts we were putting on, and he was also following Elliott Wave, and he was really stepping up the leverage, and he made a boat ton of money, and I was begging him to cash out and pay off his condo so he'd have a free place to live. And he's like, well, we got one more wave left. And that wave never came, and the market ended up going straight back up. And I don't know whatever happened to him, but I'm guessing that it did not end well for him. So that's like my quick little Elliott story there. But I would avoid anything arcane. You can ask now after the fact, somebody could give you a wave count going all the way back to the 30s, right? Well, have them give you a wave count today, and then it seems like those wave counts are only um, obvious in hindsight. Now, just to close the loop on that and any other type of arcane stuff, I have to be able to wrap my head around it to be able to use it. And years ago, I was doing some consulting. It's probably 1994, 1995 with Larry Connors. And I would get up early and program trading systems for him. And then a lot of his research I would use as fodder for more research. And I would present him with the research that I would find. Anyway, I spent hours and hours a day programming. And by the way, I think that helped to make me more of a discretionary trader. In fact, I'm a 100% discretionary trader for the most part. I did take the mechanical system with the TFM with the Qs with just 100 shares, and that did add up because we were lucky enough to catch a big trend there. But anyway, long story endless, I showed him something one day that was a mistake. And he said, well, we're going to have to toss it out. I'm like, why? It seems to work. He says, yeah, but it's not conceptually correct. So if you're going to trade something, make sure it's conceptually correct. Like I just said a few minutes ago, at a brand new high, everybody's happy. Okay. And if that market begins to drop, they feel like they're in the pain begins to start. Okay. And a lot of times people won't sell when it begins to drop. They'll sell when it bounces, should that new trend not materialize. And that's sort of the premise behind a lot of my transitional patterns is trying to capture that psychology of the market players. So if you're going to use something that is conceptually correct. If you could explain to me how Elliott is conceptually correct, then maybe I'll change my mind on that. But I think it's not a great way to trade. And just to close a loop on the Elliott wave, there were, I forget who it was. It's actually I want to say Soros or Rogers or someone like that. Somebody with a lot of money. And it doesn't matter who, but they spent millions trying to figure out if Elliott Wave works. And they have more, they're billions, right? They're worth billions. If somebody worth that much money and with that incredible intelligence can't figure out Elliott Wave, then what chance do I have with a fairly finite amount of resources and a finite amount of intelligence, right? And no staff, et cetera. So that's kind of, to me, that's the ultimate answer there when it comes to Elliott. I'll be happy to debate it with anyone who's successful doing it. But I'm going to quote somebody else, so it's not me. I think it was Greg Morris once said he's never met a rich Elliottician. And I thought that was kind of interesting. But I'm probably going to get hate mail from the Elliott people now. So HMY, that's going to be another gold stock, right? Yeah, see, now that's what you want to look for. You want to look for a stock in a nice uptrend. Look at that all-time highs, I think. Yeah, that's looking fantastic. So on a pullback, so notice your last little pullback here. That was kind of a neat little place maybe to try to get in. So the next pullback there, I think that's a good looking stock. Obviously, the big blue arrow there is pointing higher. So yeah, good eye on that one. Let me find the other stock we're long. All right, DRD. Again, a gold stock. So yeah, good eye. And that one looks pretty good. So that one looks a lot like the AGI. Okay, so AGI sold off, came down to the 30 EMA like we talked about a little while ago, and then it took off from there. So that looks pretty good. Now, the setup was right here on that one. And what I would do now, and I'd like to see it clear this prior peak a little bit more than it already has. Let's see what AGI has done. Yeah, you see how AGI got past this prior peak. So any pullbacks in AGI, and maybe I'm talking my position, but you could see it's taken off well past that prior peak. So any pullbacks here might be worth a shot, whereas the DRD, you really haven't gotten too far past that prior peak. So you want to see this, see if it can blast higher, maybe another couple of points, and then consider the pullback on that one. Let me get the some things pulled up in background, and just keep the questions coming if there's any more you guys want to talk about. So what I'm gonna do now, I'm just trying to find this other stock. It's funny, you go into these webinars and it's everything kind of escapes you. No, it was just CCL and TPR. Okay, it was TPR. Yeah, those were only two that were short. I thought we had three. So what happened was the JBL was the third one I was thinking about, but that one actually stopped out. Okay. Any more? Let's see. Now, just going through these sectors, like copper, the commodity was doing really well, but then it imploded. So I was thinking maybe we could see some setups here fairly soon, but that didn't happen. So again, the only thing that seems to be glittering is gold. There's internet. You can see so far just pulling back, and it's all these markets are below the 200. It's the 200-day simple moving average. Okay, CTGO. Okay, so this is something that I probably wouldn't be interested in, or I know I wouldn't be interested in. First of all, it's a little bit on the thin side, meaning that the volume's a little low, only about 130K on average. It seems like in more recent years, maybe the last 10 years or more, that you need more volume in stocks than you used to be. And I don't know why that is, but I would imagine that the this one could have wide spreads. It's not too bad. What's that, about 15 cents or so? But even if you did get long this stock, you've got a mountain of overhead supply. So this is a gold stock, if I can see that correctly. And it would be hard for me to get excited about a gold stock like this because people are going to look to get out at break even at this level here. And so far, you just got a couple of bars off of this base. Now, if you didn't have all this trading above this overhead supply, so to speak, an area where people might look to get out, then I'd be more inclined to say this might be worth following. But you don't want to go after stock that looks like this when the rest of the market is looking pretty good. And one thing that I may have alluded to earlier with the overall market is match the pattern to the market. So this is what gold stocks look like right now. This is what gold looks like right now. So I wouldn't try to bottom fish hoping that something would catch up, unless, of course, you had a beautiful bow tie coming in from lows and you had tons and tons of overhead, no overhead supply, I should say, then that might be worth going after. Okay, WPM versus FNV. Okay, WPM. Okay, that looks pretty good. And again, we have it, they're kind of all looking alike, right? They all kind of look like the AGI for the most part. We've had the deep pullbacks, and then we had a nice rally out of them. So WPM versus FNV, which is another one. Those two look a lot alike. Initially, I think the FNV might look a little bit better. Come back to the other one. But again, nice thrust higher, nice little knockout type of move. The trend knockout pattern. And if you want, I can give you my books for free. You can get them in PDF. DaveLandry.com/free-book. And you'll get all three books there. But the TKO pattern, you're looking for a market in a strong trend, and you're looking for like a knockout move. And that's going to suck in the shorts. The shorts tend to confuse the issue with facts. They like to short markets at high levels because they're bad companies or whatever the case may be. And if the market begins to sell off hard, I'm sorry, if the market begins to rally after the shorts get in, they're going to be forced to cover. And a lot of times they're forced to cover at much, much higher levels. And that's how some of these stocks can go parabolic. And maybe that's some of the parabolic moves we're seeing in like this FNV and the AGI and the other one. So it looks like I think the FNV is slightly better than the WPM. Okay, let's take a look at them longer term so we can get back to the other ones. FDN. Nope. FNV, I'm sorry. Okay, and then WPM. Yeah, those two are pretty much the same. And then one thing, if I can't decide between two stocks, I like to look at the historical volatility, which I have right here. And the one with the higher historical volatility is the one I go with if I reach a stalemate. And very rarely does that happen. They do look a lot alike, though. So, but yeah, both of those look good. Both of those should be on your watch list. GROY. He's bullish on the gold. Yeah. Okay. So this one kind of wide and loose and sideways. Okay. Kind of electrocardiogram or what I call a Jackie Mason stock. I don't know if anybody's old enough here to know Jackie Mason, but Jackie Mason is like, it's up, it's down, it's up, it's down. So you can see this is just all over the place. It looks like electrocardiogram. This is something I would not be interested in. Now, RGLD is probably going to trade a little cleaner than that. Yeah, look at that. Okay. So that's the stock you want to be looking at on a pullback. Now, if we get a nice little TKO type of move in some of these golds, it might be worth a shot. So keep an eye on this for like a knockout move to the downside. David, are there other panelists? Am I taking everybody's time, or is there